Jerome Powell has finally flipped, announcing that they will double the speed of their bond tapering program and providing forward guidance with respect to how many rate increases you can expect in 2022 from the U.S. Federal Reserve. The definitive guide on how to manage your credit, product, penalty, price in that order. It's never been more important to get your mortgage right. Okay, so the U.S. Federal Reserve has finally signaled that they're going to increase their bond buying tapering program, essentially buying less and less bonds as the next quarter starts to move forward, and also signaling that they will potentially start increasing interest rates sooner and by more than previously expected. Now, this was widely to be expected because obviously the inflation rate in the US at 6.8% has widely gotten out of control, and ultimately it was something that needed to be done, and that's what we're going to talk about today. But before we get into it, and before we discuss the differences between the US and Canada at this moment, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, which if we hit 20,000 subscribers by the end of 2021, and we're only about 250 away, I'm going to give away $1,000 to one lucky subscriber. In order to enter that draw, all you have to do is leave a comment in one of the videos between now and the end of the year. And also, of course, subscribe, because you have to be subscribed to win. So let's get into it. Let's discuss what's going on with the US Federal Reserve and how that impacts Canada. Obviously, we've had some inflation numbers released in the last day as well, while the US Federal Reserve was having their meetings and discussing what they're going to do in the US going forward. So first of all, let's jump into the news as we typically do, show you what BNN Bloomberg is reporting here. Fed doubles taper, signals 2022 interest rates hikes in an inflation pivot. So here's what's going on. We are seeing the US Federal Reserve realize that with with inflation at 6.8%, they needed to do something, and they needed to do something quick. So obviously what they have done is they have said that they are going to end their bond buying program in the beginning of 2022, by March of 2022. Previously, it was expected that they were going to taper and completely be done by the end of June, but they're moving this date forward, and they are signaling that there could be interest rate hikes sooner than what was expected. In September of this year, it was widely expected that there may not even be any hikes in the US. Now they are signaling that they're going to be at least 3 in 2022 if inflation continues to rear its ugly head there. Now, kind of jumping in and taking a look at this, where this is in contrast to Canada's economic picture, because obviously this is a Canadian channel, and a lot of you in the last video left a lot of comments with respect to how much you appreciate the Canadian content. So to contrast with Canada, as of right now, markets are predicting in Canada 5 interest rate increases in 2022. And what they are also looking at is the inflation numbers, which just came out, which are 4.7%. And 4.7% is what they were in October. So what we're hoping is that the inflation numbers are pretty much leveling out at this point in Canada. And really to explain kind of what happens with respect to inflation numbers is inflation is always based on the same month of the previous year. When you see 4.7% inflation, that means that prices were 4.7 higher in November than they were in November of the previous year. So what we're hoping happens is inflation numbers kind of catch up. So, we had those 8 months of high inflation going back to basically March of last year. What we're expecting and what we're hoping is that the March numbers, which were obviously higher than what we previously expected, when we hit March of this year, we're going to hope that prices haven't gone up significantly compared to March of last year. And hopefully what ends up happening is we start to see 1%, 2%, 3% inflation rather than this 4.7%, 4.8% inflation. And that is widely what's expected. Obviously, we've got some supply chain issues. We've got some issues with getting goods to market, and that is increasing prices. But as we see kind of energy prices start to filter out, and we see, essentially the market start to get a little bit closer to back to normal. Obviously, we've got Omicron that's an issue, but as things sort of get back to normal, hopefully what ends up happening is price increases start to get back to normal. And if they do, well, then what could happen is we could see less of a tendency to go to higher interest rates. But if this inflation keeps going, then the Federal Reserve Bank in the US and the Bank of Canada, they're all going to have no option but to start increasing interest rates. And I think what you could see happening if the supply chain issues don't work themselves out is you could see global central banks say, okay, we've got a worldwide problem here, not just a country-specific problem. And what you could see them do is you could see them all start to move their interest rates in a similar sort of pattern around the same time, because what they're going to need to do is essentially lower global consumption if the global issues like the supply chain issues don't work themselves out. So what you could see is you could see the Federal Reserve Bank, the Bank of Canada, Bank of New Zealand, Bank of Australia, whatever they're called, Bank of England, you could see them all start to move their interest rates unilaterally to start to reduce global consumption. Now, I'm not saying that there is a conspiracy between all of the global banks, but I'm starting to think that that is the next best move with respect to this global inflation problem, because obviously, if you have supply chain issues and that's affecting the US and Canada, and you start to see prices go up globally for goods, it doesn't really make a difference if Canada unilaterally starts to increase their interest rates, because the price pressures are coming from outside the country, and therefore an increase in an increase in interest rates here won't necessarily have the same sort of effect that it would have in an environment where inflation was going up because of growth in the Canadian economy, while other countries weren't necessarily having the same sort of issues. So it leads to a really interesting conversation. Now, what I do want to do is I want to jump you back in here, and I want to show you the Canadian 5-year bond yield, because what's interesting is over the last couple of months, the Canadian 5-year bond yield has actually come down while the expectation that interest rates are going to rise has gone up. So if we go ahead and we take a look at the 3-month chart with respect to the 5-year bond yield, in the end of November, when it started to become clear that the Bank of Canada was going to make interest rate moves sooner, so rather than in September of this year, but in Q1 or Q2, what we started to see was the 5-year bond yields go up to about 1.6%, just under 1.6%. And since that time, we've seen the market sort of ease off. Obviously, Omicron has had an effect on this. And what we're seeing is we're starting to see 5-year bond yields that are around that October level that they were previous in the year. And what that means is, while we've seen 5-year fixed rates go up, we've seen the bond yields comes down, and obviously they're normally related, and we haven't seen these lower bond yields be reflected in interest rates. So what that could mean is it could mean that coming into January, we could see some competitiveness among the banks. We could see, because of the extra profit margins that they've got built in right now, we could see different lenders start to get competitive, and therefore we could start to see lower 5-year rates. So the question is always, should I lock in right now? Obviously, I think if you've got a 1.25 or 1.45% variable rate, you've still got a long way to go before you're worse off, especially with respect to interest rate hikes. But if you're locking in right now, and we see that we've got this opportunity for 5-year fixed rates to come down and subsequently 4-year fixed rates to come down and so on and so forth, well, if you're locking in right now and we've got increased margins in the fixed rates, then you're pretty much locking in at interest rates that are higher than what you should expect to have to lock in at. So I'm not a big believer right now in locking in. Obviously, I'm a big believer in sticking to variable rates. If you've watched this channel, you know that. Long-term strategy, stick variable. You almost always come out better, and you don't expose yourself to big penalties and higher interest rates up front. But obviously, if you're in that variable rate mortgage, keep in mind that what you should be doing is you should be figuring out what you expect the 5-year fixed rates to be, whether it be 3%, 3.5% a couple years down the road, and take that, calculate out your mortgage payment at what it would be at 3.5%, and take the difference between what you're paying now and that higher payment at the higher interest rate, and start setting that aside, so if you need it in the future for a rainy day, you've got lots of cash on hand for the event where interest rates do go up. And if they don't end up going up as much as predicted, which very likely could be the case, then you've got a whole bunch of extra cash to pay down your mortgage. It's money that you haven't given to the bank in exchange for a 5-year fixed rate that you get to control the destiny of what you do with it. So, really interesting things again coming out of the US. Obviously, Jerome Powell flipping on his ideas was something that was bound to happen, especially as inflation got closer and closer to that 7 and 8% number. What this signals to the market will be really interesting. What will happen with inflation in 2022 is going to be very interesting. And a lot of that and what happens in the next couple months with respect to inflation is going to have a big impact on what happens with interest rates. And if the US Federal Reserve starts to move sooner, that gives the Canadian central bank the ability to start to move sooner as well, which means we could see higher interest rates in Canada once the US Federal Reserve has decided that they are going to make the changes. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about our race to 25,000 subscribers, now 20,000 subscribers, to get that extra $1,000 bonus, and we'll see you on the very next video. Cheers.